Well, as we reported earlier in this broadcast, the Federal Reserve has raised the interest rate today, and it's the largest rate hike since 1994. So we turn to financial advisor Mike Giordano with Williams Wealth Management to tell us what that means exactly for you. So Mike, first to the big picture. We're used to seeing the Fed raise just 0.25%. Today, for the first time since 94, they raised it 0.75%. Why that aggressive move?
Yeah, it's basically just what Chris was talking about, how hot it is outside. That's what we're looking at in terms of prices. You know, we were expecting prices to kind of roll over a couple of months ago. Last Friday, it said, nope, prices are going higher. The inflation rate went higher. And so all of a sudden, the Federal Reserve felt like we got to get more aggressive to tame prices.
Is it going to work? I mean, they're trying to head off a recession. Do you feel like it's going to work?
It can work. It's just not going to work tomorrow. These instruments are blunt instruments. So when you raise interest rates significantly, it makes consumers stop borrowing money. It makes businesses stop borrowing money. They might lay off employees. They may freeze hiring. All these kinds of things that can't be really unwound quickly. So it could take several months for it to happen. Eventually, they will get it under control, but it could be a while.
Okay, what does that mean to our viewers? That just means they're going to have to pay more money to borrow money?
Absolutely. So when the Federal Reserve raises these short-term interest rates, it affects all interest rates. If you go out and buy a house, you know, we were at 3% at the beginning of the year. We're at 6% now. If you want to go get a loan for a car, all of these types of things, you're going to see higher interest rates on all of them, which means the cost of the money is more expensive.
Right. But is 6%, I mean, I remember a time when 6% was actually pretty good for a home loan. Are we still okay?
Well, the whole question really comes down to our home price is going to come back down. And I think in this area, you've got a massive southern migration. You've got a lot of people moving in here from all over the country. So it doesn't look like you're going to get this big backup in terms of pricing. But the real problem with 6% interest rates is the fact that you've seen double-digit price increases over several years. So a home that might have been going for $200,000 a couple of years ago is now maybe going for $275,000 or $300,000. Then you stack that higher interest rate on top of it. That's the double whammy.
Yeah, and quickly, back to the 401k. We always want to make sure, are we still okay? Still keep putting money in there?
Keep putting money in your 401ks if you have that long time horizon, right? More than 5 years. The beginning of the year, bonds and stocks weren't really working for you, but bonds have gotten to a place now where they might be able to be that great hedge. Like they'll reassume their traditional position of hedging out some of that stock risk. But you know, markets over the long term, they go higher. So you just got to kind of keep putting money in, keep putting money in, keep putting money. We'll get through this storm, and then we'll have some sunnier days in the future.
Okay, we hear you. Mike Giordano, thank you so much with Williams Wealth Management.